Well, hello and welcome to this afternoon's webinar, Small Cap Value Stocks, Strategies and 2024 Portfolio Review, led by John Bajkowski. Thank you so much for joining us. We are happy to have you all here. And my name is Jenna Brashear, and I'll be your host for today. And I just want to formally welcome everyone to the kickoff event of our Model Portfolio Review Week 2025. And it's, of course, our favorite week of the year at AAII, and we're thrilled to have you join us for all the excitement. And so just to kind of reiterate a little bit, but you can join us each day this week for a fun deep dive into one of our model portfolios, and we'll take a look back at each portfolio's 2024 performance. We'll celebrate the stock wins and identify any challenges that it faced, as well as share our goals and insights as we set our sights for an exciting 2025. But before we begin, there are a few things to go over. I want to first remind all of our webinar viewers that AAII is a nonprofit educational group and is not a financial advisor, and thus not able to give personal advice. Every investor is different. That's why our goal with each broadcast and article is to educate you on how to make better financial decisions. And keep an eye on your chat section throughout the webinar for helpful resources, any kind of key information, and special offers as well. And if you have any questions for our speaker during the presentation, please submit them using the questions section of your GoToWebinar control panel, which is located on the right-hand side of your screen. And then once our presentation concludes, I'll select a few for John to answer. And if your question isn't selected during the broadcast, feel free to email us at members@aaii.com. And a handout of the presentation slides is available under the handout section of your GoToWebinar control panel, which is also located on the right-hand side of your screen. And it will also be emailed to all attendees. And if you experience any issues with the audio or the video of the webinar, please consult the instructions on how to change your device's settings, or you can consult the GoToWebinar website for support at gotowebinar.com. And just a friendly reminder that this presentation is recorded, and a replay of the webinar will be available on our YouTube channel, along with links to this presentation's handouts and any resources that we discussed today. And the PDF and recording will also be accessible at aaii.com/webinars, and I'll put that in the chat later on. But for new viewers, we always like to give a little bit of background about our organization. The American Association of Individual Investors is an independent nonprofit corporation formed in 1978 for the purpose of assisting individuals in becoming effective managers of their own assets through programs of education, information, and research. And in this presentation, John will cover a few things such as lessons from the Shadow Stocks portfolio's 2024 performance, some insights into the factors driving small cap stocks in 2024, and also strategies to empower you in all your small cap investment decisions. So, and then also I wanted to reiterate that we also have a special offer for today's attendees. So if you saw our email, I just wanted to give you a little bit of details. So our attendees will also be able to get an over $150 discount on any AAII premium newsletter that we are featuring this week during our Model Portfolio Review Week. And you can simply visit invest.ai.com/shop/products-members-SV. And we know that's a long one, so don't worry, I will add it to the chat momentarily so you can all easily access. And with that, I'd like to hand over the presentation to John.
Well, thank you so much, Jenna. Welcome, everybody. As Jenna said, it's a nice brisk winter day here in the Midwest, and thank you for joining in and coming in and talking with us and listening to us and seeing what we have to say. And Jenna is going to be listening in the background. She's going to be looking at the various messages you submit, giving some advice as far as any problems you might have, and her goal will be to try to stump me. So feel free to pass along any tough questions you might have. Our objective is to hopefully answer any questions you might have about the model shadow stock portfolio, small caps, its genesis, who it's for, investing horizon, things like that. So so with that, I'm going to get into a little bit as far as what our objectives are today. And really, slide deck is, there we go. Really, our objective here is to provide a little bit of background research on the genesis of the model shadow stock portfolio, which is a micro cap value approach. I'm going to talk about how the rules came about, how one can use the rules to construct a small cap value portfolio, And the pros and cons and why the rules came into place. Some of them may seem interesting, some of them may seem odd. And why it was really designed to be kind of a portfolio that the typical individual investor can easily follow without too much additional effort, using information that's widely available. We'll look at the model shadow stock portfolio performance. We'll look at the performance of the market. We'll look at general valuation levels, how they appear, and get a sense for, where perhaps we are in the market cycle. How have stocks performed over time? Does the model shadow stock portfolio always do well? It's a good time or a bad time, and how can one actually invest, and how can one use a rules-based portfolio to help pick individual stocks and manage portfolios as it is. Really the genesis or the origin story of the model shadow stocks portfolio, when it was first created, it was actually called the beginner's portfolio. And it was meant to be a simple quantitative approach to investing that the typical individual investor can follow and actually play to the strengths of the individual investor. And when we're talking about individual investor, we're really contrasting that against institutional investors, because institutional investors are really have limitations as far as the kind of companies they can invest in, the ability to buy positions in smaller companies, their ability to hold stocks and hold positions even when they're out of favor. Often they'll lose money and assets that way. And we, as an individual investor, we have opportunities to take a longer term perspective on the marketplace, to be more nimble, invest in smaller companies, and also not have to worry about our short-term performance as well. So it really, the notion was, can we come up with a set of rules that are quantitative in nature, that are easy to follow, that don't require too much effort in the sense of day-to-day, minute-to-minute observation, yet result in a portfolio that long-term should do reasonably well on a risk-adjusted basis. And the rules have changed over time. It's a real money portfolio. It has been since the beginning. And we have adopted the rules as we've learned what works and what doesn't work. So really, it's been an important part of a learning experience, and it allows us to share with you what makes sense as far as an individual investor in the investment process. The whole, I guess, there's a long history of small cap stocks doing well relative to large cap stocks, even on a risk adjusted basis. There's always a question of, well, is that due to liquidity factors? Is that due to risk, neglect? Those are potential considerations. But then there was a paper that came out, kind of a seminal paper in the investment community, called The Cross-Section of Expected Returns by Eugene Fama and Kenneth French. And they looked at a number of factors, and many people thought about it as the paper that kind of killed beta, because up to that point in time, beta was the primary factor, the single factor being used to assess whether or not a stock had provided alpha or up from the market on a market adjusted basis. But what they did is they found a number of different factors, and what they identified are two separate factors that worked pretty well, that independently were predictive in the sense of a factor or predictor, or whatever you want to call these things, that to the extent this number or factor changed, it tended to be predictive of future performance. And what they found was, for the most part, the smaller the company stock, and they use market cap, which is price times shares outstanding to measure that. Typically, the smaller the market cap, the higher the future rates of return. And by the same token, they also found that, typically speaking, the deeper the value, in this case, they looked at a number of different factors. A lot of them were kind of duplicates or the same, but at that time, the best value factor they found that was most predictive was price to book. And they found, typically speaking, the lower the price to book value, the greater the future returns. And but you're able to actually combine them, and they're independent enough, but when combined, you actually did better as a whole. And this chart as an explanation of that. So basically, going across all different sizes, the higher the size of the company, in terms of decile, going down this list here, the larger the company, the smaller the average monthly rate of return. And if you go across from left to right here, the deeper the value, the higher the monthly rate of return. This particular box here is all companies, And as you got to be cheaper and cheaper and cheaper, typically the monthly average rate of return was higher. By the same token, as you went to get smaller and smaller companies, typically speaking, the monthly rate of return was higher as well. And this corner solution here, this yellow corner solution, is really what the goal was of the shadow stock portfolio, was try to find companies that are in that small cross section of companies and try to basically put together a portfolio that kind of tries to find companies that are in that group, and hopefully over time, letting the portfolio come to play, one should actually do reasonably well as far as rate of return is concerned. This next slide here gives us a sense for, this is simply a decile thing. And I wanted, this slide is in here for probably really two reasons. One is, again, it confirms the notion that typically speaking, the smaller a company, the higher its average rate of return over time. But also what happens though, it does become riskier. The standard deviation of that return does go up. So there is you are paying for higher risk. You are getting more volatility year to year, month to month. But on a risk-adjusted basis, you're still getting compensated for that additional risk. But also I wanted to highlight that, when we talk about cap sizes and what we really talk about, really small cap, mid cap, and micro cap, it's important to understand that typically speaking, when you're talking about the S&P 500, you're in this large cap arena. And as of the end of last year, the largest company in that large cap arena was $37 billion. And the mid-cap group are those that are in that third to fifth decile. And in their context, again, the mid-cap can go up to 14 billion and could be as low as 4.5 billion. Now, when we talk about small caps, lots of times with mutual funds, they're actually even larger than what most researchers would call small cap in the early research area. Most of the small caps, in this case, we're talking about stocks that are probably up to 3 or 4 billion in size, probably starting off at $1 billion. Those are really that's the sweet spot of small cap stocks that most asset managers invest in, because they need liquidity to be able to buy and sell these things without moving the stock price too much. The FAMA French study looked at really the smallest 10th percent, and we get that particular number by looking at all the stocks in the New York Stock Exchange and taking their market cap and breaking them down, largest to smallest, and looking at the smallest 10%, and then taking that size range and applying it against stocks against all exchanges. So one can see that, again, on both a value basis and on a size basis, one should expect to see higher rates of return going forward if the stocks are smaller. There is more risk, much more volatility year to year, and one should also expect to see greater rates of return if that stock is cheaper in some way. And again, these are long term, and we'll have some slides later on to highlight this, is that these things don't work year to year. They tend to run in streaks. So there is some volatility, and there are periods of underperformance and outperformance that occur into this place. But this is sort of the purpose of this screen and this strategy was, can we capture this universe of stocks with a set of rules that the typical investor can apply and make use of on a day-to-day basis. So there are two primary factors or elements for the model shadow stock portfolio. One are the stocks that are in the lowest 10% decile of the New York Stock Exchange stocks applied across all exchanges, and whether or not they're NASDAQ or Amex. And we do that analysis on a quarterly basis. I happen to use Stock Investor Pro. I look at the stocks that are in the NYSE. I exclude REITs and foreign companies, which is what was done in the original study. And I find out which companies, what's the market cap of those that are in that lowest 10% decile. I also make sure that they have a minimum liquidity as well. So we exclude the smallest companies from that. We then take that capitalization range and apply it across all companies. So right now we're looking at companies that are 400 million or smaller for initial inclusion in the model shadow stock portfolio. The next thing we look at is price to book. And again, it's that lowest 10th decile. And again, there's other factors you could use: PE, price to book, price to sales, price to cash flow, EBITDA, enterprise value. Again, we happen to be using price to book, and over the study, it was the best factor to use. It's become perhaps a little bit more challenging more recently, only in that there are companies that have a lot more intangibles that aren't perhaps being captured by price to book, but it still has proven to be a good proxy for value. And the researchers haven't found that many better proxies. Perhaps a collection of tools or multi-factor things can be perhaps more valuable to use against the cross section. But price to book works pretty well across all industries, across all sectors, except for financials. And the challenge with financials is that their price to book value, their assets are part of also what they happen to use for their business. And in that context, they don't really quite well work on a price to book basis. So we exclude financials from our analysis. So right now, we're looking at stocks that have a price to book ratio of 0.9 or lower. And the original cutoff back when this series was started was 0.61. It has been as high as 1.1 back in 2021 to 2022. And right now, if you look at how this compares against the S&P 500, so we're looking for stocks that are much smaller than the typical large cap company. We're also looking for stocks that are much cheaper. So we're looking for a maximum price to book of 0.9. As of the end of last year, the price to book of the typical S&P 500 stock was 3.62. So you can see we're much cheaper than the typical large cap company stock. But the other element that people have found is that, especially when you're talking about small cap stocks, is you do a lot. There's some papers that actually have some clever names in the sense of, you want to avoid the junk. So basically, you can really improve your rates of return by making sure there's a minimum level of liquidity. You want to avoid stocks that are at risk of being delisted. You want to avoid pink sheet stocks. We don't really need to get involved in OTC stocks that aren't filing on a regular basis, that don't meet the exchange requirements. And so we want to avoid companies that have at least a minimum 30 million market cap, and that a typical person can go ahead and put an entry order in with your broker and go ahead and execute that order without too much difficulty. And also we want to have minimum $4 share price. We're looking at penny stocks here. This is not a penny stock portfolio. But also, again, it's very important that to help avoid the value trap is to avoid companies that are really in financial trouble. And this is a very minor thing we do, but we simply look for companies that are positive as far as earnings per share. And if they have earnings estimates for them, these are oftentimes now smaller companies, they may not have analysts tracking them. If there are analysts that are tracking these companies, we want those projections for the upcoming quarter and year to be positive. So we want to avoid companies that are in the negative area. And again, when it comes to small cap, micro cap, and value, simply adding a quality element to them really helps to improve your batting average and have a better chance of succeeding. Also, we found that there were a lot of companies that would be in the portfolio, would then sell them if they had negative earnings. All of a sudden, the next quarter or next year, all of a sudden earnings would bounce back up to being positive without much movement in the actual share price of the company itself. So we want to typically avoid companies that are marginally profitable, that keep bouncing in and out. So we typically avoid companies that have been in the portfolio the last 2 years. And also we're avoiding, Russian companies, Chinese companies. We've just had some trouble with companies where we have a tough time actually understanding whether or not their financials are valid or not. We've had a situation, we've had some fraud across the companies that passed the screens. So from a perspective of simply avoiding troubled stocks as much as possible, we're avoiding companies that are in this context, Chinese and Russian. Also, because of the price to book is our primary measure, we're avoiding companies that are financials, REITs, limited partnerships, things that it can't be really compared against a typical industrial company that's out there. So we have not done anything beyond that as far as financial strength, but at a minimum, that's a minimum level of financial quality. We also avoid companies that haven't filed quarterly statements with the SEC in the last 6 months. So we're looking to have companies that have reasonably current financials as far as that's concerned. When it comes to building a portfolio, we recommend that you hold at least 10 stocks. I mean, personally, nowadays that the brokerage commissions are so low, it's free, and you're able to hold odd lots easily, be able to buy 1 or 2 shares without any kind of penalty. I mean, you could quite easily hold all the stocks in a shadow stock portfolio if you wanted to. But at a minimum, you want to make sure that you're spreading. If you have a large portfolio, holding 10 stocks and trying to sell a big position of these less liquid stocks, you're going to move the stock price. It'll take you time to sell it, especially if the market happens to be weak. And by the same token, you could get caught in a stock that's shooting up if you start to buy big positions and all of a sudden the stock price is going up. So again, it's you want to hold as many stocks as you're comfortable holding, minimum 10. And it's best to start off holding equal dollar amounts. Some of these some of these prices on these stocks are all over the place. So you're much better off trying to look at the equal dollar amount. If you're going to invest in, say, 10 stocks and you've got $100,000, just do equal, $10,000 amounts in each portfolio, each security in the portfolio. And again, if you are going to be building it over time, take a look at what your typical position will be and just simply add that typical position as you buy stocks that are currently qualifying and build up to that. These happens to be the current stocks that are in the model shadow stock portfolio right now. And I'll point out later on, we can find this information on our website, but this is the list of the 29 stocks that are in the portfolio. And this happens to be ranked by price to book. So they're cheapest to most expensive. In this case, Castor Maritime is the cheapest stock on a price to book basis. It has a price to book of 0.05. And again, its share price is $2.86. It's below a $4 minimum right now. But again, this is the notion of you would, if you were going to be building a portfolio, you wanted to get a sense for stocks that currently qualify. You might take a look at those holdings that pass our list online that are indicated as being currently qualified. So they meet all of our minimum rules for requiring. So Stealth Gas, Land Sea Homes, we have Fonar, Amplify Energy, Pangea Logistics, which is a shipping company, Rocky Brands. Other notes you want to probably highlight here. So if a company has negative earnings, trailing 12-month, 1 quarter, we don't settle immediately. We put it on probation and we wait to see whether or not the company has negative earnings in the following quarter. So we have American Vanguard Group, which went on probation in the 3rd quarter this year. And again, that's also why its PE ratio happens to be not meaningful. So it has a negative trailing 12 months earnings from a GAAP basis as well as an adjusted basis. If in a subsequent quarter it has negative earnings, we're going to go ahead and sell it. But now DMC Global happens to have adjusted earnings that are positive, even though its GAAP earnings are negative. So that's a stock we'll just simply hold on to. We'll keep a watch on how its earnings go. It won't be currently qualified at this point in time, but again, those are stocks that we kind of keep an eye on. If a stock starts to get too expensive because of its market cap or its price to book, you'll also get notes in here online that indicates that it's approaching a value limit or a size limit as well. When it comes to actually making decisions, now the critical part of the model shadow stock portfolio was that we wanted to make it easy to manage. And it was, Jim called it a beginner's portfolio because the cycle of decisions was really centered around when companies would release really pertinent information that would cause you to make a decision. In this case, the pertinent information was really the quarterly earnings cycle. So on a quarterly basis, after most of companies have reported their quarterly earnings, we go ahead and do an analysis of the marketplace. We take a look to see what the current price to book and market cap break points are. We then look at each company, look at its reported earnings to see if it's still on a trailing 12-month positive, look at its price to book ratio, its market cap ratio, and we make a decision whether or not it makes time to go ahead and still hold it in the portfolio or let it go. Now, the important thing to consider is that even though we may buy a stock when it's a deep value, so we'll buy a stock when it has a price to book of 0.9 or lower, but we want to hold it for a while. We want to let that stock to rise in value a little bit before it becomes expensive. So really, we're not going to sell it to become 3 times its initial qualifying position. So in this case, stocks are sold, removed from the shadow stock portfolio if their price to book goes to above 2.7. And again, that's only if there are suitable replacements. So if all of a sudden the market gets very expensive and the stock happens to be 2.7, but there is no other candidates available, we'll hold on to it for another quarter to see if anything else comes out there. Same is true for market cap. And right now our market cap, initial market cap maximum is 400 million. So they're sold, moved from the portfolio, if they go 3 times that initial, which is 1.2 billion or 120 million dollars. And again, if there's suitable replacements. Now, when it comes to negative earnings, no matter what, if a company has has reached 12 months of negative adjusted earnings and a future quarter has negative earnings, we will go ahead and sell it for earnings probation. But no matter what, even if there are no options available to no qualifying companies passing, we'll go ahead and remove that stock from our portfolio. And also the other rule we have is if a stock's been in the portfolio for some period of time, 4 years, and it's not going anywhere, and its rate of return is negative, even though it may not still be expensive or large, we'll go ahead and sell it as well, and we won't buy it again for at least another 2 years. We want stocks that are basically moving up in the portfolio itself, is how that's concerned. So it's important to really kind of have rules in place. I think, when it comes to success as an investor, having rules in place, having your rules decided ahead of time is also critical. And you can fine tune them over time, but you really want to know what's guiding you. And because when things are going well, you may be tempted to hold on to things too long. And by the same token, even when stocks are doing poorly, you may be tempted to kind of hold on to your losers because you want to make sure that you didn't make a bad decision. It's too tough the sell decisions are often much harder than the buy decisions. So it's important to really have rules in place ahead of time that hold yourself accountable, that make sense financially, that make sense on an investment basis that you can follow no matter what the market's doing, that get past your emotions. So really, the notion here is to really have a sound set of rules in place. And I think as you sit into some of these other model portfolio presentations over the course of the week, I mean, there are different rules in place depending upon the market cycle you're in, market environment, but having a quantitative set of rules that make sense financially that you can follow is really the key to long-term success. And so really knowing when to sell, which is very tough for many people, is one of the factors that really helps lead to long-term success. With that, I'm going to talk a little bit about the model portfolio performance as well. So 2023, 2024 was actually kind of a tough year for the model shadow stock portfolio. It underperformed the market. It was actually down 4.5% in December, and that left its return in the red for the year. It was down 4.7. And really, over the last 10 years, small cap value has underperformed large cap growth. This next slide here, I think, is kind of an interesting slide. And the thing that you're going to find out that is the case with these microcap approaches in general is they tend to have streaks. What they found with microcap approaches that they may not perform every month, every year, every 10 years, but they typically go on winning streaks and losing streaks by that same token. This chart indicates that when the shadow stock portfolio was going up on a month-to-month basis relative to the S&P 500 versus when it was going down. And for the first few years of really the first 7 years of the model shadow stock portfolio, it tended to underperform the market, as that was really an environment in which large cap growth companies did well. The 2000s was really a great period of time for value investing and for small cap investing, especially. There were some financial crisis downturn here, but really starting, I guess, back in 2013, that was really the last 10 years is when large cap growth has outperformed small cap value and value in general. And so in this context, we see that the line of relative performance is going down. We had a bit of an uptick here before the pandemic, a big uptick here. This is the year after the pandemic when really small caps shined. And typically, when value comes into play, and value has been a while since value has been that popular, is when also small caps do well. And what we've found, and what other people have found with small cap investing, is that any given month, it's a crapshoot, 50-50 almost, whether or not a particular strategy will do better than any other strategy. Really, you have to get out almost really to 5 years before you have a sense that you're more than likely to perhaps outperform the market based upon the approach. So again, this is a relative investment concept of large cap versus small cap, but really, with the 5-year time horizon, 5-year holding periods, 59% of the time, the model shadow stock portfolio outperformed the S&P 500. And you start increasing your holding period to 10 years, 77% of the time it outperformed the S&P 500. But there's no guarantee in life, and I mean, even at 20 years out. There were 3 10-year periods out of that rolling 10-year period cycle where S&P 500 outperformed the model shadow stock portfolio. So the odds are in your favor to do better than large caps. And again, I think it makes sense to have it as part of your overall portfolio, or offer some diversification against large caps and opportunity for some greater return. But with the understanding is that you'll probably have to, at some point in time, live through a period of underperformance. And that's why it's important to understand the history and the cycle of investing so that you don't jump out at the wrong time. Because, having been involved with the association now since '87, I've lived through quite a few market cycles. And, it's typically, it's the tendency to really fold in the cards at almost the worst time when it comes to investing, as far as that is concerned. When it comes to bull and bear markets, the shadow stock portfolio has traditionally had more down periods. A correction of 10% or greater we've had 11 for the model shadow stock portfolio versus the 6 for the S&P 500. They've tended to be shorter in duration, but more severe. Probably the exception is the current one. And the same is true for bear markets. There have been 6 bear markets, 20% or greater declines for the model shadow stock portfolio versus the S&P 500. Typically, they're shorter in duration, but they have been more severe as well. But this current one we're in has been longer than average. When it comes to holding period with losses, I mean, the chance of having a loss. At any 1-year period, there's a 27% chance of having a loss. Any 5-year holding period, a 5% chance of having a loss. Now, with the model shadow stock portfolio, we haven't had any 10-year holding periods where there has been a loss, which is a little bit better than the S&P 500. And that's, I guess, what we've seen with the model shadow stock portfolio is typically its declines are more severe, and typically it typically goes up higher, faster than large caps. But past results are no guarantee of future returns, and I recycle a little bit different. History doesn't repeat itself; it does rhyme, but it means sometimes the rhyme's a little bit off that way. As far as what we've seen in the market itself, I mean, 2024, a second year in a row now where large cap S&P 500 outperformed smaller companies, and growth was really where it was to be at. We have to go back to 2022, where kind of the opposite was true, and we had 2 years in a row where the S&P 500 returned over 20%. That's a pretty rare events, and pretty much growth outperformed value. And really, not looking back 10 years here, really for the last 10 years, the large cap growth has been where it's been at, and one can't deny that's the case. Now, what's happened is, as a result of that, is that the S&P 500 has gotten very concentrated. So these are the top 10 stocks that make up the S&P 500. What you'll find is that right now, about 38% of the overall market cap of the S&P 500 is made up by the top 10 stocks. So this level of concentration is much higher than we've seen since '96. So what's happening is the strength of these companies is helping to not only support the overall level of the index, but also support the growth of the index. And whether it's a self-fulfilling prophecy is tough to say, but there is a great level of concentration that's occurring. And one talks about the Magnificent Seven. This even goes to a smaller segment of that group. They've really helped pull up the performance of the S&P 500. The green line here is the performance of the S&P 500 here, of the Magnificent Seven within that group, and you can see that outperformance that has occurred. The darker line in the center is that of the S&P 500 as a whole, and if you take out the Magnificent Seven, this is what the return would have been for the 500 over this time period. So really, they've had a tremendous contribution of performance to that particular group. When it comes to last year, it's sort of interesting. This is from Data Trek Research. And what their observation has been is that when it comes to interest rates and small caps, and here they're using the Russell 2000 as the index to measure small cap values. And their observation recently, and this is taking last year and breaking it down by quarter, is that environments in which the interest rates were either high or going up, small caps underperformed large caps. And they think that's because it's kind of almost a proxy for opportunities and also risk taking. When interest rates were going down, it was a general sense of enthusiasm and a little bit higher level of sentiment. And when people are a little bit more optimistic about the economy, especially domestic economy, small caps tend to shine, and people are more risk taking, and that's the context in which small caps typically do better. So that was the third quarter of this year where really interest rates were going down, investors were generally happy, and in that case, the Russell 2000 outperformed that of the S&P 500. The other market cycles, rates were rising or high for the most part. We saw the S&P 500 outperform. And in that case, again, you had the small group of proven stocks that had strong earnings that are driving up and keeping those valuations high. The other element to consider when it comes to market cap and industry concentrations and size is, what factors or what role do sectors have on a performance? And it's rare to have long streaks where one sector outperforms another streak, but really what you invest in will have a major impact on your performance. And I think looking at these are our year-by-year returns of these sectors within the S&P 500, as well as the indices below. And 2024, I think the big surprise perhaps was utilities. Utilities went from having a loss of 7.1 last year in 2023, one of the two sectors to have a loss, to actually being one of the better performing groups last year. And that was kind of an odd one. That was like last year, I guess, was the year of the AI, but it's not only the AI directly, but also the AI companies that benefited from AIs, construction companies that are building data centers, utilities were supplying electricity for these data centers. A AI chat search, ChatGPT search takes a lot more energy than a simple Google search. And the data center construction in the U.S. has been tremendous. So we've seen a lot of growth in even utilities. And this happens to be a sorted by the most recent best performance last year. We can see on a typical year, the sector you're invested in will have a major impact on your success or failure. And so it's passing a current screen may also be kind of interesting to take a look at. When it comes to the actual composition, we see that the S&P 500 is much more heavily invested in info technology, much lighter invested in financials, much lighter invested in healthcare, has a smaller percentage of industrials. So if you're invested in industrials, financials, healthcare, that's going to impact your index performance and your portfolio performance. And also, this is an interesting chart from JP Morgan, and it shows what percentage of companies are unprofitable. And right now, within the small cap arena, a pretty large percentage of companies are unprofitable. And the expectation of a stronger economy middle of last year kind of helped boost small caps. But right now, the quality of growth, the strength of info technology is really helping to boost the S&P 500 over the last few years. When it comes to the holdings within the shadow stock portfolio, this chart breaks down the number of holdings, 29, how they're situated, and our greatest concentration currently in the portfolio is in the industrial area, which mirrors more closely what you'd find in the mid cap and small cap arena. Now, as a group, the industrial, the typical, the median or midpoint of all stocks in the industrial segment was down 4.2, was up 4.2%. The average stock was up 19.4, and the price earnings ratio of the typical industrial stock right now is 24.6. Now, when it comes to things like price earnings ratio, two things can drive that. One could be increasing price. Another thing that could be decreasing earnings, quality of earnings. I think real estate in this case has had terrible price performance recently. And if you went back to the previous chart, you'd see that it actually did pretty poorly in previous years as well. Yet it has a high PE ratio. Part of it is because earnings quality has been low. So again, earnings quality can also drive PE or support a higher PE. If a company is growing profitably, you could support a given level of price. So right now, because we don't have any financials by our qualitative rules, we're underweighted in financials. There are no consumer staples currently in the shadow stock portfolio, no utilities, no real estate. So those concentrations will come into play. And the typical stock actually was interesting at the median versus average. I thought that was kind of fun to include both, is that the typical energy stock, for example, was down 1.7%, but some of the big gains by some of the highest gaining stocks actually brought the average up of a typical energy company up. Info technology was the big winner. I mean, on both a median typical company being up 7.6% and the average being 75% up last year. Just incredible. So if you're invested in info technology, yeah, that was a good place to be last year. And this chart here shows the biggest winners and losers. In fact, it shows all the stocks that were held in the model shadow stock portfolio last year. If you happen to see under the portfolio weight or reasons sold, so like in this case, Natural Gas Services Group had the highest return on investment last year. While it says return while it was held in the portfolio, it's currently 8% of the portfolio, so it's a little bit higher weighted than average. It's in the energy sector. Below it, we have Global Ship Lease, which we actually sold last year because it exceeded its size limit. Its market cap went above. Time would have been probably 900 million when we sold it. And it was in the industrial sector. So you see that reason sold. So most of the companies that had positive rates of return, if they were sold for positive reasons, exceeded size limit, acquired. We had LS Starlit acquired. In this case, Keytronic had a 4-year rule. It's simply long-term rate of return was not great enough to keep holding on to it, but it was still positive as far as rate of return last year. The companies that had negative earnings or losses are the ones that were most negative last year. So Ampco, Pittsburgh Corp, biggest loser last year at 61% of its portfolio. And that's why it's important to have a group of holdings. I think it's important to have as many as possible. I think, even 10, I think I prefer to hold all of them if with the exception of those that are on probation. I think, what you're going to find is you're going to have a couple of really big winners, and it's going to really help, if you hold on to them long enough, it's going to really help boost your portfolio return long term. And when it comes to where you could, as an investor and a member of the association, where you can get information. So as far as where to go, if you log into our website, if you go under portfolio, there is the model shadow stock portfolio homepage. We have the most recent commentary here available. We have any recent portfolio additions or deletions, as well as most recent performance. And if you click on portfolio, shadow stock portfolio, you get a list of the current holdings that are in there. And again, pay attention to notes. They'll tell you if something is really under probation, if it's approaching size limit, as well as archive to any kind of news that's in there. So it's really, I think, a good resource to take a look at. If you subscribe to our monthly email, we'll also update you to what's going on in the portfolio. And this, again, is our current portfolio that's in there. The ideas list, if you wanted to find out additional, whenever we do screens, we want to add stocks to it, we start at the ideas list. In this case, I think there were about, I forget if there were about 18 or so passing today. And this happens to be ranked by price strength, so the ones that have had the most recent price strength. Here we have Telesat Corporation, which is a Canadian operator of satellites, communication satellites. I think it was used by DirecTV, as well as almost a competitor in some ways to Elon Musk's satellite company as well. And they provide communications for the Canadian government, and a small cap company. And it's a chance to get new ideas. Now, again, you're going to have to potentially screen some of these out. Like here I see, you don't screen this for price, or in this case, we have a limited partnership here. Companies that are currently held in the model shadow stock portfolio, they have a little check mark here. And you could click on, if you click on the ticker symbol, you can go ahead and do some additional research on our website. Things, I know grades require A+ investment subscription, but these other tabs should not be available to members of the association as far as that's concerned. Now, looking forward, I mean, what do we know? And this is something that Charles made note of, is that, you know, stocks tend to gain during the first year of a presidential term. If you look at what analysts are projecting, most analysts are projecting for the market to go up 14%, or at least earnings to go up 14% this year. If earnings go up, either it could support a higher stock price as far as that goes. I mean, the U.S. economy is growing. I know we'll have another read on the economy this Friday, and inflation has moderated. So those are all positive trends. You know, what's challenging is that it's rare to have multiple years where the S&P 500 does above 20 year after year. I mean, you had the fabulous 90s where that was the case. I mean, we had the last 2 years. You had interesting. This is actually during World War II, where that kind of interesting. We had 2 years during World War II where the stock market was going up. So back-to-back years are somewhat uncommon. So celebrate it when you get that. When it comes to valuation, the S&P 500 itself, having gone up so much, is starting to get a little bit expensive right now. Look at its PE ratio as an example. Its forward PE ratio is 21.47, and that's you know, 30-year average is 16.86. So it's more above average than it has been. If you were to put that kind of PE based upon past trends, in the past, when that PE has been at that level, at this point in time, you know, they're less likely to have big higher rates of return over the next year. I guess there's more variability year to year. If you look out 5 years forward, it's less likely to have big pops of return going forward when the PE has been this high in the past, and a little bit higher level of confidence of that. Is this a year where small caps value is going to come back? I mean, we've been saying that for some time, but there is much more value to be found in that arena. If you look at where small caps are right now, the small cap PE ratio is small cap value is 17.2 relative to its 20-year average that's just slightly above. Whereas if you look at large cap growth, you know, that's 150% of where it has been historically. So right now, you know, value is relatively cheap to growth, and small cap is relatively cheap to large cap. So if you just play the odds, one opportunity to, if you think the market's expensive, is to explore parts of the market that are less expensive. And right now that happens to be the value segment as well as a small cap segment. And I mentioned this before, but I mean, small cap stocks tend to run in streaks. There are points in time where they outperform, and there are points in time where they underperform. And this is an interesting chart that came from the Capital Group, and it noted that going back to the 1930s, you know, there are really 3 big points in time where the small caps really underperformed and they kind of lost leadership. That was during the initial the space age, and then they did quite well, benefiting. They weren't the participants in creating the space age, but they benefited from that, from the initial Internet 100 run, 1.0. They were the big benefit, the 2000 benefit afterwards. Right now we're in the age of AI. Will they be the big benefit? I mean, they might not be the ones that are producing all of the AI advances, but they might be the ones that benefit from that. They're the ones that take advantage of using the AI tools to service their customers, to create better marketing, to create better content, whatever it might be. So that might be the benefit of that. It might improve their productivity. So as we've mentioned, small cap stocks tend to run in streaks. They tend to outperform for 5 to 7 years and underperform for 5 to 7 years. It's been 10 years now, so one would hope that there is some turnaround available in that regard. When it comes, it's important to have a long-term perspective. Micro caps are more volatile than large caps. It's important to have a diversified portfolio. For most people, you want to have this be just part of your portfolio allocation. It's important to have all other asset classes, some sort of cash component, a large cap, foreign potentially, depending on your overall asset allocation. You want to maintain reasonable expectations. I mean, the market's reasonably efficient, but it takes time for the market to adjust. It doesn't adjust on a dime, and no one rings the bell when you're at a market top or a market bottom. It's if you really want to succeed, you need what were the keys and why was it determined? How do we come up with these rules? I mean, if you're going to manage a stock portfolio, even though the rules are pretty straightforward with the model shadow stock portfolio, and we try to make the thought process that quarterly review and regular monitoring was enough. It still takes time to manage a stock portfolio. You have to look at it periodically. You have to make sure that you're keeping an eye on it. You got the time to read the news. You got the time to look at the financials. It still is important to keep an interest in doing that. You can't walk away from it. You could buy a equity index fund and walk away from it, but you really can't put together a stock portfolio and walk away from it for a year. You really shouldn't. You should really kind of keep an eye on what's going on. You need the discipline to really follow it over time, good and bad. And when it comes to small caps, it's important to really control turnover. As far as otherwise you're going to be eaten alive making your transactions in and out of the portfolio. So I've been talking quite a bit here. Hopefully I've spurred some thoughts and some interest. I did include some additional elements in the appendix that covers some things like turnover, how performance has been during bear markets, drawdowns, things like that. Our rules over time. So feel free to look at the appendix as far as further information. But with that, I'm going to throw the ball back to Jenna and see if you guys have any questions for me.
Yes, we got a lot of questions. Yes, we got a lot of questions in. And so I appreciate everyone, sending in your questions throughout the broadcast. I tried to compile as many as I possibly can. So we'll try to stump John a little bit and see what we come about. But also I want to at first I do want to ask John a question, because I'm going to ask this all week long. Is what is the one thing that surprised you the most from 2024 that impacted the shadow stack portfolio?
Oh, the one thing. I think for me, the one thing that surprised me the most was that, and I guess it has a function of expectations, but when the Federal Reserve started to lower interest rates, what happened is that mortgage rates went up, and that to me was the kind of a bit of a surprise. I thought it would be more of a trend towards more affordability of homes and housing, and mortgage rates have such a big impact on the economy. Have the ability for investors to buy a home. There's a big multiplier effect as far as homes and cars if rates are lower. And then if you buy a house, you probably have to paint it. You have to buy furniture. You got to decorate it. I mean, that's a big multiplier there. So to me, the Fed started to lower rates, but the market had already anticipated that the Fed was going to lower rates, so mortgage rates went down before the Fed lower rates, and then so they've since come up. So that to me, I think was probably the big surprise. And that, I think, put a damper on the fourth quarter, I think, as far as returns.
That makes sense. All right, let's take a look at some of the questions that we got in. I think we're still getting a few in as well, so feel free to keep submitting them as we go through these. Let's see. I think the first question that kind of gets the conversation rolling is, what type of investor would benefit from the shadow stock strategy? I think a couple of members asked, any type of investor that should be wary of following a small cap value strategy.
Well, I think in terms of suitability, I mean, as we've noted, you have to have a bit of a longer time horizon. So anytime you invest in stocks in general, it has to be money that you don't need, in the next, 5 to 7 years at a minimum. So you have to be willing to commit to the equity markets with the understanding for the odds to play in your favor, you're going to have to wait for some time potentially. I mean, yeah, the market may bounce back strongly and you'll do quite well over the next year, but really on a year to year, it's almost a coin flip. Will the market be up or down? It's really a long-term cycle is the key. So you have to have longer your time horizon, the better. And whether it's for you or for your heirs, for your family, having a long-term perspective. So I think I think it's like anything. I think it's important to have perhaps part of your portfolio. I like to, small caps are a great complement to large cap, and having some base cash as well in there to help balance it during good times and bad.
That makes sense. Actually, one of my questions was, how does a cash holding fit in the model portfolio? So I think that you answered that question. Let's see what else we have. Okay, let's see. So how does the shadow stock portfolio handle dividends? Is reinvestment included in the overall strategy?
Yeah, the question is regarding how we handle dividends. We simply take the cash that the produced. First of all, we don't seek out dividends, and dividend payouts are typically lower with some of these smaller cap companies, unless they're in a more mature company. We simply take the dividends that we accrue and hold it in cash, and then when it comes time to buy a new position or reinvest on a underweighted company that still passes, we would then take that cash and invest it in that company. So we don't directly do a direct reinvest. Now, if you wanted to, a lot of brokers do offer that opportunity. Nothing wrong with doing that, doing a direct reinvest. You'll have to obviously keep track of that, those lots. Most brokerage firms will do that for you, but obviously you want to keep track of that. So when it comes time to selling it, you'll have a notion of what your tax losses are or gains.
Makes sense. And we talked about when you were talking about the sell and buy rules. We talked a bit about probation. So how do stocks get off of probation? Is there a timeline that you stick you stick to usually, or how does that work?
Yeah, no, it's up to the company and whether they turn profitable again. We had that happen to a company this past third quarter, and I'm drawing a blank on the company, but it had got out earnings probation. So it's trailing 12 month, last 4 quarters of earnings were negative. And then for the next subsequent quarters, it kept reporting positive quarterly earnings, and eventually the positive quarterly earnings overcame that one bad quarter where negative earnings were in place. So in that context, every time a company reports its quarterly results, one quarter falls off, one quarter gets added. Hopefully the company had a one-time bad period, and it's now bouncing back, and its positive earnings are going to overweigh that one poor performing quarter. Typically, when companies have multiple quarters of bad earnings results, that's when they get sold for earnings.
That makes sense. And for an investor who is actively watching the portfolio and following it, should investors sell stocks in the portfolio when they reach the market cap sell indicator before the update issues a seller recommendation, or should they wait until they get that alert to sell?
I mean, it's really up to you. I mean, in some cases, and again, we're selling it, especially market cap more so than the price to book ratio. I mean, in many cases, if the value is still there, if it's still attractive on a price to book basis and other value measures, I mean, if you have room for those kinds of stocks in a different part of your portfolio, if you have room for mid cap stocks or large caps, I mean, there's nothing wrong with holding it in that context. We sell it because it's no longer a micro cap stock. So if there's nothing wrong with you being proactive and selling in advance. Now the market may move. I've had situations where all of a sudden the market moves down, and what was a stock that was above the market cap level all of a sudden wasn't. And the other thing is that we do review our market deciles every quarter. So this past quarter, we raised the decile from 300 million to 400 million. So our sell level went from 900 million to 1.2 billion. So again, if there's a chance that the market cap range will change as well. So that would be a potential situation where we're not gonna be selling it because all of a sudden the market cap range changed.
Mhm. That makes sense. And let's see. Oh, we talked a little bit about fraud. You mentioned it when you were talking about stocks that you avoid and things in the portfolio. So how do you handle stocks with like misleading reporting, insider deals at non-market price, fake addresses or claims? I think earlier you mentioned that you avoid basically fraud issues, but I think the investor was just asking maybe for more
Well, I
specific.
mean, that's generally speaking. Anytime, I mean, you have to obviously figure out what. In our case, I think it was a company. It was a U.S. company. It had I think it was gaming machines in China, and there was some question as to whether or not they were properly accounting for the gaming machines. So it came out in a filing. And anytime you have any kind of concern, I mean, you have to obviously read what the issue is, but in most cases, there's so many good companies out there, and quality is important. If you have any suspicions about a company, more often than not, it's best to walk with your feet and just go ahead and if it is taking a loss, but then just go ahead and find something that you have more confidence in. But in most cases, if it's something minor, if it's a company is simply delayed in its filing, we'll hold on to it. We've done that in the past. But if it's something that's really more serious, we'll go ahead and just issue a we'll sell alert.
Makes sense. And kind of on the same, plane, how do you account for the management quality in your analysis? You taken that
We
into account as
don't,
well? Okay.
unfortunately. I mean, that's I guess the other thing as to why it makes sense to hold as many stocks as possible.
Hmm.
Um, the the quantitative rules for the model shadow stock portfolio are generally not very. I mean, there aren't that many of them. There's a price to book component, market cap component, positive earnings, and liquidity. Not too much beyond that. So really, in that context, you really have to have a larger number of stocks to help protect yourself. To the extent you do deeper analysis on those stocks and you do a deeper dive and you look at what is the quality of earnings, well, how is the ROE, return on assets, how is the turnover, how does it compare against other companies in the industry. The closer you look at those companies, the more it is possible to hold a smaller number of companies. So in this case, in order to really to benefit from these broad rules for the shadow stock portfolio, it makes sense to hold as many as possible. If you want to hold fewer, you have to do more careful analysis.
Makes sense. And actually, we had an investor who asked, they have SI Pro, as one of their services, and they were wondering, how do they use SI Pro as a, another extra layer of data analysis? Is that something that those data points,
Yeah,
can you find
well,
those things in SI Pro?
very much so. In fact, if there is even a built-in screen, there's a shadow stock screen in there, but all these data elements are in there, and there you can create a view to track whatever you want to look at. Company comparison, you can look at how a company's leverage of liabilities are to its assets. You could take a look at its growth rates. You could get a better sense for what insiders are doing with earnings estimates, if they have them, whether the revisions are positive or negative. But again, what they found with small caps is if to the extent you could look for small cap companies that have better quality and also a little bit of momentum, price momentum. Those are two factors that are different, but really can improve your odds of doing well in this particular universe of investing.
Makes sense. And we actually had quite a few people who asked, would AAII ever approach a penny stock portfolio? And if not, is there a reason why?
Would we ever? For the most part, no. I think there's enough opportunities out there. I know that the universe of companies is shrinking. I mean, we know that. With private equity, companies are waiting to go private, waiting to go public, rather, longer, and more of them are coming out to be more mid caps or large caps. And in many cases, some of the more attractive small cap companies are being bought out by private equity. But I think the exchange listing helps to ensure that the company, at a minimum, is audited statements, is filing regularly, that there's some oversight as to what they do. And I think there's no need to really to go into the speculative penny stock area. Too often, there's too many risks and unknowns there, and I don't think really as an investor we need to do that.
Makes sense. And I saw some members reacting to the portfolio being down, and then also reacting to also just like long-term holding. Some people who had been in for a variety of market cycles, and then a lot of people who are maybe new and just joined in 2022, 2023. So when portfolios are down for the year, how do you suggest those holding stocks to react? Do you have any advice or ideas on how to manage emotions during down years?
For me, I think that the best thing is just to get educated. I mean, it's a challenge because I've spoken to many of our membership groups over the years, local chapters, and the ones that stand out the most are when we're speaking at a local chapter, and the market's been down for a period of time, and everyone's kind of feeling glum, and it's if you could live through that, if you don't need that, if you don't need that money, if you don't sell at the bottom, and you could, these stocks have bounced back. The market has bounced back. I think, as long as you don't sell at the bottom, you have opportunity to do better long term. And I think, even looking at Jim Clunan's strategy for determining whether or not you're going to be living off your equity portfolio or your cash portfolio in a given year. Is just if you have enough cash set aside so that in a down year, you're not forced to liquidate your stocks and allow them to bounce back, that's proven to be a long-term strategy that's been positive. So the key is not to have to sell it at a bottom.
That's good advice. And let's see, there's a little bit about some questions about diversification. Just wanted to talk. So has there, let's see, I guess how do you manage the diversification as far as like the size, industry, sector, and how do you suggest others to do the same?
Yeah, that's a good question. I mean, we don't necessarily explicitly do any kind of diversification. When it comes to a quarterly review, we try to, based on the rules that we have in place, we look for stocks that have if there's a tie break, well, first of all, we make sure there's enough liquidity in the stocks, make sure that the financials are up to date, make sure they're not LPs or foreign companies, and then we rank them based upon their price momentum. So for us, it's a question of looking at, we don't really do any kind of industry concentration bets, but that does happen naturally in terms of what's passing at the point in time. You will see at different points in time different kinds of industries that are passing. I mean, like no utilities are passing the shadow stock universe right now. That's just the way it is, and I'd have to change the rules completely for any of them to pass.
That makes sense. Let's see, I think got quite a few. We got a lot answered. A lot are coming in still, so I'm just going to take one more since we're over time already. So I think I'll actually let's see. How do you measure the value of earnings or the quality of earnings? I know you mentioned that quite a few times in your presentation. So how does AI actually evaluate that?
Yeah, there are different. We do a very simple one for the model shadow stock portfolio. We're simply looking for companies that have positive earnings and have positive expected earnings. But we actually do have a quality rank. A plus investor has a quality ranking and looks at other factors. And we even have for example, if you take a look at the Bajkowski screen, there's an F score in there that looks at things like accruals and elements like that. So if you were to take a look at like the Bajkowski screen, the quality rank itself, an A plus investor that looks at such as things such as levels of debt to equity, or levels of debt to total assets, especially when we want to compare typically those types of factors against other companies in the same industry, because the levels of debt vary by acceptable level from industry to industry. So looking at positive cash flow from operations probably is a good measure of quality as well, confirmation of earnings quality. Those are all things that are really helpful in that regard.
Makes sense. Well, thank you, John. I
Yeah.
appreciate you answering all
But
the questions.
I'll tell you what, if someone wants to learn more about quality, earnings quality, you should probably listen in to the value, momentum, and quality
Yes.
presentation that Cindy will be doing later this week. She'll be probably touching on quality in a much greater depth than I just did.
Yes, if you want to register, I reiterated in the chat, but John made a very good point. If you want to attend any of our other model portfolio events this week, especially Cindy's, which she will talk about value, then
And
please
quality.
visit, yeah, and quality and momentum. Then you please visit ai.com/webinars, and you can see all the different events that you can register for right there. But before I go into my outro and everything, I wanted to give you, John, and do you want to say anything to the audience before we move on to our special offer, and then a little bit more information about what to expect for the rest of the week?
Well, I just thank you so much for attending today. I think, first of all, I think, no one takes as much interest in your personal well-being as you do. And I think becoming educated on the market, what drives the market, understanding the historical situation, just arms you as an investor to succeed long term. And I think, typically speaking, I think we can be both our worst enemy and our both supporter. And when we let our emotions drive our actions, that's when we come into trouble. So simply becoming educated about the market, even if this approach isn't for you, understanding its pros and cons and what environments it does well and who it's for, will just give you something to understand. And I think education is the key to long-term success and knowledge. So again, I think feel free to sit in on all of our presentations this week. I'll be talking about the stock supercharger approach as well on Friday, and in that context, we'll talk about 4 different guru approaches, everything from a price and momentum strategy to a deep value strategy that has earnings estimate revisions in it. So again, just becoming educated on what makes sense. I know it can be overwhelming at times, but then listen and then find what resonates with you, because once you find an approach that kind of resonates with you, you can stick with it and become an expert in it, and it becomes secondhand after a while, and then you have the confidence to work through any kind of market upturn or downturn.
Couldn't agree more. And for also, I want to, first of all, thank you so much, John, for taking us through the Shadow Stocks, stocks portfolio, the performance, the look at, at 2024. Also, what we can expect for 2025. I hope everybody, stays tuned and actually takes a look at the Shadow Stocks portfolio. I put a lot of resources and helpful links in the chat, so feel free to go look at, the stock ideas if you want more small cap stocks to, add to your portfolio. I added in to look at the performance or the holdings. So take advantage of all those, member benefits that you have access to. And if you have any questions about the shadow stock portfolio, its performance, or anything that I mentioned, as well as if you have any questions about other AAII member benefits, feel free to email us at members@aai.com, or you can call us at 312-676-4307, and that's Monday through Friday, 8:30 a.m. to 5 p.m. Central Time. And I just want to give everybody, we have an exclusive offer for our attendees today. So you can get a 1-year subscription to any AAII premium newsletter that is featured in this week's events for just $97, which are regularly priced $249 each, which is about a little bit over 150 in savings. So that's really great. And then with your subscription, of course, you'll gain access to valuable resources, tools, and also this week's events. So you can visit invest.aai.com/shop/products-members SP. And I'll put that in the chat one more time, but it'll also be in the email that you receive, that all attendees will receive. And then it'll also be listed on that AAII.com/webinars page as well. But you can visit there to learn more and subscribe. And that offer will be valid through January 10th at 11:59 p.m. Central Time. And if we didn't answer your question and you still would like to submit it, feel free to email us at members@aai.com. We're happy to answer any questions that our members have, especially about the Shutterstock portfolio. And like John mentioned, if you want to attend Cindy's presentation on Thursday for VMQ stocks, or John's presentation on Friday for SSR, please visit aai.com/webinars, and you can register there as well. And then lastly, because we got a lot of questions in the chat, this presentation was recorded and a replay will be available at aai.com/webinars later this week, early next week, and it'll also be available on our YouTube page as well. And then webinar attendees will receive an email with the link in the next few days, so keep an eye on your inbox. And then you'll also receive a copy of John's presentation slides, as well as any other links to resources that we discussed today, or anything that I put in the chat, it'll be in there as well. And with that, we wish all of you viewing good health, good fortune, and a great rest of your day. Thank you, stay warm, and take care.
Thank you so much, Jenna. Take care, everybody.